Good day, everyone, and welcome to our webinar for May month. It's obviously been an interesting month, a unique month. We're now, I think, in our 41st day of lockdown. South Africa's COVID situation seems to be staying more or less under control with a relatively low death rate. We're getting more and more cases, of course, as the testing rate increases, especially in the Western Cape. I'd like to begin today by having a look at America, as we often do, and on the screen you can see there the S&P 500, which is obviously an index of the 500 largest companies trading on Wall Street, and there I've superimposed the 200-day moving average, the blue line, for you to see. And you can see that we had a very sharp downward trend at the beginning, and then reached a bottom over here, and since then the market has basically been moving up quite strongly. Back in March, over here, around about here, we said that there would be a V bottom on this bear trend, and that it wouldn't follow the pattern of normal bear trends, but would rather follow the pattern of what is perceived to happen with the virus itself. And that is more or less what has been going on. As you can see, we made a fairly sharp turn here, and that happened on the 23rd of March at a index level of 2237. Since then, it's been climbing quite steeply, and you can see we're up here now. On Friday, last Friday, there was a slump because of two things. First of all, Apple came out with a profit warning and said that it expected a drop in its sales of iPhones, especially in China, and that unnerved the market somewhat. Apple is generally the leader of the tech sector on Wall Street. At the same time, Trump decided to renew his trade war with China, and that caused the market to slump there, as you can see, by 2.8% in a single day. But the market is pretty much used to Trump's erratic behavior, and so recovered very quickly, and you can see that by last night the market was moving back up again. Obviously, what is going on the S&P 500 reflects what's going on all over the world, and particularly the fact that countries worldwide are starting to relax the lockdown that they've been going through, and that is being reflected in the rising S&P 500. At its highest point since the bottom of the cycle, at this point here, it was about 61% recovered. So of this downward trend, approximately 61% had been recovered. Normally, if this was going to be a dead cat bounce, it would not go above 50%. So for the fact that it's at 61% should give us some hope that the V bottom will continue, and that the market will continue to rise over the next few weeks. Right, let's turn our attention to the South African economy. Obviously, the lockdown was extended, as we all know, and now we're in a staged unwinding process, which is not significantly different from lockdown. Obviously, a very, very difficult decision for the president to make, but necessary probably in the circumstances. For the thousands of client-facing businesses out there, especially small businesses, the extension to the lockdown and the very slow unwinding process could have been the death knell. Small business is the largest employer in South Africa, so a failure of a lot of small businesses will certainly lead to higher unemployment. The squatter camps, of course, are the whip end of the economy. There are thousands of them in South Africa, and they are facing a real starvation threat. The government has been distributing food parcels and has increased the pensions and grants, so that will help. But to get an idea of what is actually going on with small business, the Rupert family and the Oppenheimer family have a relief fund called a Sukuma Relief Fund, and that has been overwhelmed with more than 10,000 applications for assistance and 2.8 billion rand worth of support. they've actually been forced to stop taking applications because of the number of people. They can't process them. Unemployment may reach as high as 50% when all is said and done. Those businesses and individuals who were debt-free at the beginning will survive the best. Stats SA says that 42% of businesses in South Africa do not have the funds to survive this COVID-19 pandemic. The economist Ricardo Hausmann has said that this is really Hobson's choice. Do you allow 10% of your population to die from COVID, or do you allow 100% of them to be endangered by starvation? The lockdown is clearly not economically sustainable, but it does buy us time to get the medical situation under control, to build field hospitals and so forth. The lull in the number of cases in the first 3 weeks of April appears to have just been the calm before the storm. Infections and death rates are up, they are rising. The death rate seems to have stabilized at about 3% of cases. Many field hospitals have been opened with intensive care facilities to cope with the rush of new sick people. The coming winter may accelerate both infections and deaths, so that is something to consider. Of course, COVID, the virus is happiest and most virulent at about 3 degrees Celsius. The problem is that the lockdown is not targeted and impacts the entire economy. Instead of just impacting on the hotspots, it impacts everybody. We just don't know where those hotspots are because we haven't been doing sufficient testing. However, the testing is ramping up. We're now doing about 12,000 tests per day, and we have a target of 36,000 tests. Perhaps the best example of how to manage the COVID situation is given by South Korea, who did massive countrywide testing right at the start of the virus, and they have more or less got it under control now. The impact on the economy is difficult to assess. Some industries are doomed, clearly. Airlines, we see that Comair has filed for business rescue. Restaurants, sports stadiums, malls. Can famous brands and Spur and Comair and other smaller companies survive? Will consumers return to shopping malls? Probably yes, but not with the same sort of footfall. Does that mean that mega shopping malls like the new Fourways Mall are unsustainable? Quite possibly. Will South Africans ever go back to restaurants? Certainly not for a long time. Will Monte Casino and other casinos survive? That is not clear by any means. Remember that for casinos there is definitely an online option available to those people who wish to gamble. We see also that there are failures in the print business. So there are lots of people who are looking at liquidation or insolvency. Those that survive will obviously be a shadow of their former selves. Other industries may benefit though, particularly IT and communications businesses. Data usage is up sharply as a result of the lockdown. Businesses and consumers are adapting to the new normal. Work from home, which was relatively small before COVID, is now the way forward. It's the only way forward. Everything is moving online. Shopping online, which was less than 2% before COVID, is accelerating rapidly and will accelerate even further when deliveries of all goods are allowed. This will destroy shopfront businesses that cannot adapt. Private investors should study the markets and look at the direction of things. Shares that have become cheap in traditional businesses, like retailing, may not be bargains, even though they are cheap. They may fall further. And then, of course, there is the impact on the ANC, our dominant political party. The Zuma-Gupta ANC is one of the victims of COVID-19. What is emerging is a leaner, more efficient, and probably less corrupt party. No longer a party deeply divided between Zuma and Ramaphosa camps, the pandemic has consolidated and entrenched Ramaphosa's leadership. He has been acclaimed worldwide for his handling of the virus. Most South Africans can see the disaster that would have happened if Zuma and, worse still, Minister of Finance Malusi Gigaba, had been in place when this virus struck. But we will take time to recover. Mr. Kayaswaita, who's the Commissioner of SARS, says that tax revenues are down sharply. GDP is expected by the Reserve Bank to be minus 6.1% this year. Inflation is expected to fall further to around 3.5% or even lower. But the Reserve Bank is expecting GDP growth to be 2.2% in 2021 next year. So obviously that will be off a low base, but the economy will by then have substantial capacity. One of the limitations to growth in any economy is capacity. But when we start growing again, probably next year, we will have enormous capacity. Lots of trained staff, lots of factories and which already have the required equipment in them and so forth. Capacity will be enormous. Eskom, of course, has used the lockdown to refurbish and do some maintenance. And hopefully that means that when we come back to the economy, we will not face any more power shutdowns. But obviously Eskom's income has plunged because its usage has dropped by half. The downgrades, which were done by Moody's and Standard & Poor's, were lost in the COVID storm. They did impact on the rand. The rand has fallen sharply, but mainly because of the shift to risk-off sentiment amongst overseas investors. The first government bond auction, which took place after the start of the lockdown, was actually a success. It went quite well. 4.5 billion rands worth of bonds were placed on the 31st of March 2020, and the auction was actually oversubscribed. But what you have to bear in mind is that it was oversubscribed at yields above 10% on 5 and 10-year bonds. So it may prove expensive in the longer term. A survey done by Willis Towers Watson indicates that 41% of companies in South Africa are planning retrenchments. We will see the economic pain at its height probably in October and November of this year. After that, things should slowly improve, hopefully with fewer structural impediments. So there are some lessons to be learned from this COVID crisis. The first one is always to live within your income so that you always have no debt and substantial savings. Maximize your annuity income. Whatever income you can get that is not having to be resold every month, you should maximize that, whether you are a private individual or a business. And of course, the other lesson which you can learn from this crisis is always to have a strict stop-loss strategy to protect yourself against black swan events. Stop-loss is one of the great advantages that you have over the big institutions, and you should use it. Amazingly, the government is still trying to rescue SAA. This seems hard to believe. In fact, they plan to start a new, as they call it, profitable airline. We think this is nonsense. Seriously, this is not a time to be launching an airline. If you're going to launch any business, it should not be an airline. Airlines are going bust all over the world. And in fact, I had thought that one of the great good things of COVID-19 was the demise of SAA. Anyway, it doesn't seem like it's going to be like that. The land bank's default has added to the burden of the fiscus. Obviously, the fiscus, the treasury, will have to pay that debt because it's guaranteed by them. And if they don't, then all guaranteed debt, government guaranteed debt at state-owned enterprises will be at risk. Okay, now we should turn our attention to the rand. So I'm just going to go to that chart quickly. The dominant factor with the rand has been the shift to risk-off sentiment. Internationally, investors have shifted rapidly towards risk-off, which means that huge quantities of international money have fled to safe havens and away from emerging markets. The safe havens are obviously two. gold particularly, which offers no return, and US Treasury bills, long-term Treasury bills, the 10-year bill, which actually has a negative return. The rand, as you can see, has fallen 23% in 2 months, from around 15.50 to the US dollar to 19.30 to the US dollar. At that level, it seems to have created a double top, which you can see on the screen there. Obviously early days to call this a double top, but it does look like one, and the rand has been strengthening since then, more or less. Obviously the rand is the most liquid of all the emerging currencies, and that means that it's the favorite of international speculators, and therefore it tends to be hit hardest in both directions. But what we are looking at on the chart here does look like some signs of new strength. Let's consider commodities now, just for a moment. In the commodity business, force majeure has been the name of the game. A force majeure is usually a clause in all contracts which allows the people who have signed the contract to get out of the contract, or certain elements of it, if there is an act of God. And obviously COVID can be regarded as an act of God. These force majeures mean that all sorts of people, from Exaro to Sasol and Anglo-American and Richards Bay Coal Terminal and others, are basically reneging on the agreements that they made, because they say that they are facing an act of God and they should not be required to stick to those agreements. Obviously, coal supply to Eskom is declared essential and therefore is more or less guaranteed, but coal exports have been severely curtailed. Iron ore production is down sharply, but remember that the price of iron ore, the 62% iron ore that we produce here in South Africa, is now $93 a barrel. So it's actually ticked up slightly because of demand from China. The oil price, if we just go to that oil price chart, which I think is very interesting and very useful. Just put a bit more data on the screen here. You can see there's a cycle low there at 50.80, and that was broken here quite convincingly. Since then, the oil price came down. It reached a low point here of about $18 a barrel, but it does look like it's going to tick up off that low point. And as of this morning, it's trading at $28 a barrel, so it's gone up quite nicely. I believe that if you want to know what's happening to the world economy, this is the chart that you should be looking at, the oil price. I think oil will recover quite substantially, despite the renewable energy move. In the short term, oil will certainly tick up, and it's a very good benchmark of what is happening in the world economy. So keep your eye on it. Okay, the gold price. Well, the gold price has been exciting, to put it mildly, especially when you look at it in rands. So I just want to get that chart on the screen here. In fact, the rand price of gold went above 32,000 rand for the first time ever. And you can see even now it's hovering around 31,300. This is good news, obviously, for our gold mines, many of whom are making super profits in the current situation. The rise in the rand price of gold is partly because of the rise in the dollar price of gold, but also partly because of the fall in the rand itself. Okay, let's now turn our attention to the companies. I'd like to begin by looking at the JSE Banking Index. If you're looking around the market and asking yourself what shares are cheap, what high quality shares are cheap in this market, then you mustn't overlook the banking shares. Banking shares are trading at what I consider to be absurdly low price earnings ratios. Nedbank is sitting at a 3.8 PE ratio, ABSA at 4.8, Standard Bank at 5.4, and FNB, which is obviously the strongest of them, at 7.65. Even Capitec, which has always been way out front, is sitting on a PE of 15.8. The bank's index shows that there is a basing formation that has been created in the last month or so. and it looks to me like they're going to rise off this level. Don't forget that the big banks are favorite institutional shares, and the big institutions will be looking for places to put their cash when this COVID crisis is over. So this could be an opportunity for private investors, and you should have a good look at it. The question is, when will the bear trend end? And in our opinion, it has already ended, as you've seen from the V bottom that we showed you earlier. And one advantage you have now if you buy a big bank is that you're not paying the prices that you would have paid back over here. You're buying it much cheaper. And obviously that is going to be a benefit, especially if you keep a strict stop loss strategy. Or maximum loss, including dealing costs, would be 15%. But I believe that banks could go up 50% to 100%. Let's look now at property shares just briefly. I saw that Foschini has decided not to pay rent in April. That's a dangerous precedent. Obviously, landlords are having to accept rent reductions all over the place. This will weaken some of the real estate investment trusts, and the weaker of them may go into liquidation, especially if they have very high loan-to-value ratios. So take a look at the LTV before you buy into rates. All right, now I want to look at Altron. Altron is a very interesting company. It's been in the process of reinventing itself. Put a bit of data onto the screen, maybe even 10 years. Yeah, this chart here shows you a very interesting situation that has been happening with Altron. What I've got on the screen is a 270-day exponentially smooth moving average, and that, as you can see, has been a very good sort of mechanism to use with this particular share. Gave a very good moving average sell signal over here in October of 2014, before this long downward trend. Then we had an island formation here, classical island formation with an upside breakout. At the same time, there was a moving average buy signal. And then we've had the market rising fairly steeply from there. Now, this is the COVID-19 impact, and you can see that it's recovered quite sharply from that. You mustn't forget that Altron is in the process of unbundling its UK operation, which is called Bytes UK, and that should result in a release of value. It's expected to take 9 to 12 months to do that, but Bytes will ultimately be listed separately on the LSE, the London Stock Exchange, and also the JSE. It will come to the London Stock Exchange with an IPO, an initial placement of funds to raise money, and this whole exercise could be, of course, delayed by COVID, possibly to some extent, but I believe this will be an opportunity for private investors. Altron and Bytes both have a very strong relationship with Microsoft. You mustn't forget that Altron has basically taken over the role which EOH had with Microsoft as their lead agent here. Then I want to talk about Master Drilling. This is one of my favorite companies, has been for some time. It's in a very tough position. It specializes in drilling exploration and other holes for the mining and construction industry. It has diversified away from South Africa and now has operations in North and South America and in Europe and elsewhere. It has a new technology with a new type of tunnel boring mechanism, which allows it to basically drill tunnels for the mining industry, horizontal tunnels with an upward or downward slope of about 12 degrees. This mechanism is both cheaper and faster than the traditional blast and clear mechanisms that mining houses use, and it could revolutionize mining completely. And now the share is on a price-earnings ratio here of under 4, and to us it looks like good value. The next company I want to consider is EOH. EOH has obviously been much in the news. The share price has fallen dramatically. If I go back over the last 5 years, you can see here how the share has fallen from these high levels here at around 174 Rand. That was in October 2016, to the low that it made down here, which was 255 cents. Since then, it seems to have been tracking up a bit. So what we see here is potentially a good bottom. This company is the type of company that should benefit from the COVID crisis, because it's an IT company involved in communications. Most of its staff can actually work from home, so it has that big advantage. And most of its income is in the form of annuities, retainers, and so forth. The unfortunate thing about it is that it's swamped by debt. So it's got 3 billion rands worth of debt. It's been selling off non-core assets to reduce that debt, and it's also cut salaries by between 20 and 25%, which should save about 50 million rand a year. As you can see here, we've got something of a saucer bottom forming, and we consider that the situation where it is now is probably indicative of a new upward trend. What is interesting is to go back and look at how it got to this situation. You can see there's a clear double top here at the top of the screen, followed by a failure. This is a final failure, what we call a final failure. So the double top, where the share came up, tried to break above that high over here, failed, came down, tried again, failed even worse, and then went into a downward trend. So that's the kind of thing you need to learn from as a private investor. Anyway, we think that although it's probably a highly risky option at the moment, it is nonetheless cheap, and you have got this saucer bottom building there. The next share I want to consider is Zeda. Zeda is PSG's agricultural arm. PSG owns 43.7% of this company, and as you can see, they have just sold off their share in Premier Milling to the big international company PepsiCo. PepsiCo bought Premier for about 1.7 billion, and Zeda got a very nice chunk of that money, which it has mostly paid out in the form of a 230-cent special dividend. Now, even after that special dividend, the company has a sum of the parts valuation of 367 cents, and as you can see here, last night the share closed for 180 cents. So it's trading at half of its sum of the parts value, and I think that looks like a bargain to me. I would be looking at that very closely. The next share I want to consider is Afrimat. This is also one of my favorite shares. It's an open pit mining company. It produces composites of various different types, and now it's getting into base metals and minerals. It's been protected against the fall of the construction industry by its diversification into mining. The share has been moving sideways for about 3 years. So if we look at a long-term chart here, you can see it's been tracking sideways. There was an upside breakout before COVID, but it's come down as a result of COVID, and we think it is now in a recovery phase. They are looking to expand their business into other base metals like manganese, chrome, and coal, and for us the share looks cheap at these levels. Let us now consider Pan-African Resources. This is an interesting company. It's listed both in South Africa and on the London Stock Exchange. They are a retreatment gold producer. So they take the mine dumps and they reprocess them and extract tiny amounts of gold, but they have a very nice low cost of production. So they produce 1 kilogram of gold for 450,000 rand against a current price of around 700,000 rand per kilogram. The share has been in a strong upward trend since March last year, and we believe that it will spike further on the rising gold price. Remember, gold is rising in rands, both because of the rising gold price and also because of the fall of the rand. Okay, let's look at MC Mining. Don't confuse this with the MC Group, which is the new multi-choice group, which is on the stock exchange. So MC Mining, this is a small coal producer. They run a mine called the Umkomst mine, and they produce coal with contracts from various people. What is interesting about this share is that it's trading at the moment for about 206 cents. but it has a net asset value of 1,425 cents. So there's a lot of value here. And as you can see, there's a double bottom formation over here, and the shares rising off that double bottom at the moment. So as the world economy recovers, we expect the coal price to go up. This could be a share that you could look at. And then finally today, before I sign off, I just want to talk about Capitec. As you know, you probably read in the media, PSG is looking at unbundling its very large stake in Capitec. PSG has got 30.7% of Capitec, which is worth around 46 billion rand. Obviously, this unbundling may be delayed because of the impact that COVID has had on Capitec's share price. But we see this as an enormous release of value to shareholders. So that makes PSG relatively attractive as a share. Anyway, just drawing your attention to that. Ladies and gentlemen, thank you for listening to me today. Stay safe, stay home, and I'll talk to you again in a month's time.